Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. If you are an investor in Indian stocks, let's be honest, 2025 has felt, well, a bit boring, hasn't it? It hasn't been a disaster, but it hasn't been exciting either. It's been like a long, slow walk on a familiar road, while just nearby you can hear the party in other markets. Markets in places like Taiwan and Korea have been sizzling. They have been the exciting sprint, but the Indian market, lukewarm, lackluster. It's been a story of relative underperformance on the global stage. But what if I told you this boring walk might be the calm before a massive storm? A good storm, because a powerful new idea is gaining traction amongst top global strategists, and it points directly to India. An idea that could make 2026 a very, very different year. Even more important than that, the very ground beneath our feet, the Indian stock market, has perhaps fundamentally changed. The old rules we used to swear by, they could be becoming obsolete. And if you don't understand this new landscape, you risk being left behind. Now let's be clear, to call 2025 a disaster for Indian stocks would be completely wrong. It's been a relative return disappointment. Well, that's a fancy way of saying other markets did better. But for us, it wasn't an absolute return catastrophe. Our money did not vanish. Why? Because of one powerful force, you, the Indian domestic investor. While foreign investors were busy selling, who was buying? We were. Through our systematic investment plans, our SIPs, and direct investments, Indian households have created a rock solid financial floor for our market. We have become the heroes of this story, providing stability against global shocks and foreign investor whims. This sets the stage perfectly for 2026. The idea I mentioned is called the reverse AI trade. Think about it. Right now, the whole world is going crazy for artificial intelligence or AI stocks. The valuations have shot through the roof. But veteran strategists like Chris Wood believe this euphoria will eventually unwind. Maybe because of capacity issues, or those crazy high prices, or just technological hurdles. When that happens, all that global investment capital will need a new home. It will go looking for markets that are not dependent on the AI story. And which country has a vast domestic economy and a diverse industrial base, completely separate from the AI hype? India. So if global fund managers, our foreign institutional investors or FIIs, start acting on this reverse AI idea and return to India, their money combined with our steady domestic support could light a fire under the market. But, and this is the most critical part, their relationship with our market is not what it used to be. You see, for many, many years, the Indian stock market was like a puppet on a string, and the FIIs were holding the strings. When they bought, markets soared. When they sold, markets crashed. It was that simple, and it was especially brutal for small cap stocks. Now, history gives us some scary examples. There were two separate times in the past where the BSE small cap index fell by a jaw-dropping 60 to 70%. These crashes were triggered by FIIs pulling money out. The panic was real, and it left a generation of investors terrified of big corrections. Now let's look at what's happened recently. In 2022, FIIs sold a massive rupees 1.2 lakh crores worth of Indian stocks. So by the old rules, the market, especially small caps, should have collapsed. But what happened? The BSE small cap index ended that year down by just 2%. Just 2%. Now in 2025, FII selling has been even more aggressive, over rupees 1.4 lakh crores, and again the small cap index has only seen a small decline. This is unprecedented. This is resilience. It proves one thing: the Indian stock market has grown a strong domestic backbone. It can now stand on its own 2 feet even when foreign investors run for the exits. This is fantastic news for the long-term health and stability of our market. But, and this is a huge but, this very stability has broken one of the most reliable old school strategies for beating the market. For years, a very popular and successful strategy was called tactical asset allocation. It sounds complicated, but it was simple. You would move your money between different types of assets. The playbook was easy. Reduce the stock exposure after a big market rise. Build up a large cash reserve. Sit and wait for a big market crash of 40 to 50%, which used to happen every few years thanks to FIIs selling. Then deploy all your cash back into the market at low prices. This strategy worked like a charm. In fact, let me show you some real backtesting results. Now imagine a model portfolio created between December 2013 and December 2019. It was a simple 60-40 portfolio. 60% of the money was in a basket of 20 deep value small and micro cap stocks. The other 40% was in safe fixed deposits earning 6% per year. Every year, the portfolio was rebalanced back to the 60-40 split. The result, this 60-40 portfolio outperformed the BSE small cap index handsomely. It returned 2.6 times the money versus 2.1 times for the index. Why did it work so well? Because during that period, the market did crash. Between December 17 and December 2019, the BSE small cap index fell close to 30%. But the model portfolio, with its 40% fixed deposits, safe fixed deposits, was down only 20%. That lower fall during the crash is what allowed it to outperform in the long run. But the game has changed after 2019. The same 60-40 model portfolio run from December 2019 to October 25 has underperformed. The BSE small cap index is up almost 4 times. The 60-40 portfolio is up only about 3 times. Why this underperformance? Because the deep, fear-inducing crashes have disappeared. The market corrections we see now are short and shallow. If you sit with 75% of a portfolio in cash today, waiting for a 40% crash, you might be waiting forever. In the meantime, the market, pushed up by domestic investors like you and me, just keeps grinding slowly higher. You miss all those gains. The opportunity cost of being out of the market has become immense. The old tactic of market timing and sitting 40% in fixed deposits is becoming ineffective. So if we can't rely on big crashes to give us cheap buying opportunities, where will our market beating returns come from? Well, the answer has shifted. The heavy lifting is no longer done by moving between stocks and cash or fixed deposits. Today, the heavy lifting must be done by stock picking. Now please hear me clearly. This does not mean you should abandon all caution and start speculating in random tips-based stocks. No, the timeless principles of investing are still sacred. The difference between an investment and a gamble is as important as ever. The concept of a margin of safety, is buying $1 for 50 cents, is still the bedrock of smart investing. The change is in our mindset and our application of these principles. First, we need to cast a wider net. Instead of only looking for deep value turnaround stocks, we should also look for companies that show they can grow their earnings consistently and at a high rate. Second, we need patience for multi-baggers. In a market that does not offer deep bargains often, being happy with the 50% to 100% return on a single stock may not be enough to truly outperform. The new game requires immense patience to find and, most importantly, hold stocks that can become 5-baggers or 10-baggers, stocks that give you 5 or 10 times your money. Of course, not every stock will do this. Some will even be losers. But just one or two of these huge winners in your portfolio can make the entire difference between average returns and spectacular life-changing wealth. So to bring it all together, yes, India could become the world's favorite reverse AI trade in 2026. Yes, foreign investors might come back and we will keep investing. But our core principles must not change. We don't need to become speculators. We just need to be more flexible. We must see that the market's new strength has closed one door, the door of waiting for huge crashes. But it has opened another, the door that leads to a landscape where deep research, disciplined stock selection, and the patience to hold quality growth companies are the ultimate keys to building wealth. The Indian market is growing up, it's maturing. It's time our strategies did too. Well, that's all from me today. I'll see you again in the next session. Goodbye and happy investing.